Hello everyone and welcome back to the channel. If you are watching this for the first time, please do hit that subscribe button and turn on the bell notification so you never miss an update on UK property news that could genuinely affect your financial future. Today we are going to have a very honest and detailed conversation about what is happening in the UK property market right now, and more importantly what this means for you, especially if you are a senior living in the United Kingdom trying to make the most of your retirement years. I know many of you watching are in a position where every penny counts. Perhaps you have worked hard your entire life, paid off your mortgage, and now you are living on a pension that does not stretch as far as it used to. Or maybe you are still carrying some property debt into retirement, and the thought of rising or falling interest rates keeps you up at night. Whatever your situation, I want you to know that this channel is here to break down complex property news into simple terms that actually make sense for your life and your circumstances. Now let us talk about what is really going on with property prices and mortgage rates in Britain right now. The entire UK property market is essentially operating on one massive assumption, and that assumption is that borrowing money will continue to get cheaper over the coming months and years. After the absolute chaos that we all witnessed following Liz Truss's mini-budget back in 2022, when mortgage rates shot up past 6% and essentially froze the housing market, rates have been on a downward journey throughout 2024 and continuing into 2026. This decline in mortgage rates has picked up speed dramatically in recent months. Major high street lenders like HSBC Nationwide and Barclays have been cutting their rates multiple times, engaging in what many experts are calling an aggressive price war. Some of the smaller specialist lenders are now offering rates as low as 3.4% for borrowers who can put down a 40% deposit. Now I know that sounds wonderful on the surface, but let me explain what this really means in practical terms for ordinary people. When mortgage rates were sitting at 6%, someone borrowing £300,000 would be paying approximately £2,000 every single month just to service that debt. At 4%, that same loan would cost roughly £1,400 per month. That is a saving of £600 every month or £7,200 over the course of a year. That difference is absolutely enormous, and it explains why we have seen such a dramatic surge in buyer demand over recent months. People who were completely priced out of the market 2 years ago are suddenly running their numbers again and thinking they might finally be able to afford a property. Financial markets are currently expecting the Bank of England base rate to fall to approximately 3.25% by the end of 2026. This expectation has been baked into everything from mortgage rates to property valuations to buyer decisions and lender risk models. Estate agents up and down the country are advising buyers that rates will keep falling. Sellers are pricing their properties based on continued affordability improvements. Property developers are planning new projects assuming that strong demand will continue indefinitely. From individual first-time buyers right through to massive institutional investors, everyone is making decisions based on this assumed trajectory of falling rates. Here is where I need to give you some straight talking that you might not hear elsewhere. The problem is that expectations and reality are increasingly diverging. The Bank of England has been communicating recently that they are far less confident about continued rate cuts than the financial markets seem to believe. And if the Bank of England disappoints these expectations, the entire property rally we are witnessing could collapse immediately. This is not fear-mongering, this is simply understanding how interconnected these markets really are. The Bank of England's ability to cut rates depends entirely on inflation remaining under control. And here is the difficult truth that many property commentators are glossing over. Inflation is proving far more stubborn than anyone expected. Yes, headline inflation has declined from those frightening peak levels above 10% that we saw back in 2022. However, core inflation, which excludes volatile food and energy prices, remains elevated at around 3.4%, which is well above the bank's 2% target. Service sector inflation is particularly concerning, sitting at around 5% as of early 2026. This reflects wage growth feeding into prices for everything from haircuts to restaurant meals to professional services. Now I want to pause here because I know many of you might be thinking, what does inflation have to do with my property or my retirement plans? The answer is everything. When inflation stays high, the Bank of England cannot cut interest rates aggressively because doing so would risk making inflation even worse. And when the bank cannot cut rates, mortgage rates stay higher for longer, which affects property prices and affordability across the entire market. Average wage growth across the UK economy is currently running at approximately 5.2% annually. Now, while workers might celebrate pay increases after years of real terms pay cuts, this wage growth actually creates inflation pressure that limits the bank's ability to cut rates. Higher wages mean higher business costs, which get passed through to consumers as higher prices. This creates what economists call a wage price spiral, which central banks fear because it makes inflation self-sustaining. The bank simply cannot cut rates aggressively while wage growth remains this elevated without risking a return to higher inflation. The Labour government's budget announced significant public spending increases, including substantial public sector wage increases and major infrastructure investment programs. The Office for Budget Responsibility estimates these measures could add half a percentage point to inflation over the next 2 years. While this spending might boost long-term economic growth, it adds demand to an economy that is already running quite hot. When governments stimulate through spending, central banks have less room to stimulate through rate cuts without overheating the economy. This creates a fundamental policy conflict where the government wants growth through spending while the bank wants to control inflation through maintaining higher rates. Something has to give eventually. We also need to consider that the Bank of England does not operate in isolation from the rest of the world. Global economic developments increasingly constrain their policy options. The Federal Reserve in America has signaled it will maintain higher rates for longer than previously expected. US inflation has proven persistent and the Fed is prioritizing inflation control over growth stimulation. If the Bank of England cuts rates aggressively while the Federal Reserve holds steady, the pound weakens significantly against the dollar. A weaker pound makes imports more expensive, which directly feeds into inflation. The UK imports substantial quantities of energy, food, and manufactured goods priced in dollars. Currency weakness translates directly into higher prices for British consumers at the supermarket and at the petrol pump. Global trade policy has become increasingly unpredictable, with major economies implementing tariffs and trade restrictions. These policies increase costs throughout supply chains and feed into consumer prices. The UK's post-Brexit trade arrangements remain complex, with ongoing negotiations affecting everything from agricultural imports to financial services. Trade uncertainty creates inflation risks that limit the bank's confidence in cutting rates. Global energy prices also remain volatile due to geopolitical tensions and production uncertainties. While energy prices have moderated from peak levels, they remain elevated and subject to sudden spikes. Energy costs affect inflation both directly through household bills and indirectly through business costs. The bank must factor all these energy price risks into their rate decisions. Now let me explain what all of this means for property prices specifically. The entire property price surge we are witnessing depends on continued rate cuts. If those cuts do not happen, or worse, if rates must rise again, the market consequences could be severe and immediate. Current buyer demand assumes borrowing costs will keep falling. Many buyers are stretching themselves to maximum affordability based on current rates, with the expectation that refinancing in 2 or 5 years will be cheaper. If rates remain elevated or increase, these buyers face severe payment shocks when their fixed terms expire. Someone who can barely afford payments at 4% simply cannot afford the same property at 6%. This creates forced selling as overstretched buyers cannot refinance or maintain their monthly payments. Forced selling floods the market with supply just as buyer demand collapses. We saw this exact pattern play out in 2022 when rates spiked following the mini-budget. Transaction volumes collapsed by nearly 30% within months. Sales that were already proceeding fell through as buyers lost their mortgage offers or could no longer afford the properties they had agreed to purchase. Estate agents reported chains collapsing throughout the country. Buyers who had already sold their existing properties found themselves in temporary accommodation as their onward purchases fell through. The current rally is creating the same fragile conditions. Property chains are lengthening as activity increases. If confidence evaporates suddenly, those chains could collapse simultaneously. For those of you who are seniors and homeowners, this matters enormously. Perhaps you are thinking about downsizing to release some equity from your property to supplement your retirement income. Or maybe you are considering equity release schemes. Understanding the direction of the property market is crucial for making these decisions at the right time. If prices fall after you have made your move, you could find yourself with less equity than you planned for. The impact of any market shift would vary dramatically by region. London and the South East, where prices are highest relative to incomes, face the most severe affordability constraints. Even small rate increases price out substantial buyer pools in these areas. Northern regions and Scotland, where prices are lower relative to incomes, have more affordability cushion. However, these regions also tend to have weaker economic fundamentals and lower wage growth. A national rate increase affects regions very differently, potentially creating a fragmented market where some areas boom while others experience significant price falls. Buy-to-let investors face particularly severe pressure in the current environment. Mortgage rates for investment properties sit approximately 1 to 2 percentage points above residential rates. At current levels, many buy-to-let mortgages carry rates of 6% or higher. Rental income growth has not kept pace with mortgage cost increases. Many landlords are operating at negative cash flow, essentially subsidizing their rental properties from other income. If rates remain elevated, more landlords will exit the market. However, they cannot sell quickly because buyer demand is constrained by the same high rates affecting their refinancing. This creates a buyer-seller standoff where transactions become very difficult. Property markets are driven as much by psychology as by fundamentals. Confidence can shift suddenly, creating self-fulfilling prophecies. Estate agents are already reporting some concerning patterns. While viewings and inquiries are up, serious offers remain below peak levels. Many buyers are running their numbers and realizing their affordability depends entirely on rates continuing to fall. Some buyers are explicitly waiting to see whether predicted rate cuts materialize before making any commitment. This wait-and-see approach could become self-reinforcing if enough buyers adopt it. Sellers are pricing properties based on recent comparable sales and optimistic forecasts. However, these asking prices assume buyer affordability continues improving. If buyer demand stalls, sellers face difficult choices. Either reduce prices to attract buyers in a weaker market or withdraw and wait for better conditions. Either choice reduces transaction activity and undermines price growth. Media narratives about the property market can shift very rapidly. 18 months ago, headlines screamed about falling prices and market collapse. Now headlines celebrate surging demand and rising prices. These narratives influence behavior. Buyers fear missing out during positive cycles and fear catching falling knives during negative cycles. A shift from positive to negative narrative can happen within weeks, fundamentally altering market psychology. Beneath all the rate speculation and market psychology lies a fundamental problem that I really want you to understand. The UK builds far too few homes relative to population growth and household formation. The country adds approximately 220,000 new homes annually, but needs at least 300,000 to keep pace with demand. This shortfall has accumulated for decades, creating a structural supply deficit. Planning restrictions, land availability, infrastructure constraints, and construction industry capacity all limit supply growth. No amount of monetary policy manipulation solves these underlying supply shortages. Housing supply problems are most acute where demand is highest. London and the South East have the worst supply-demand imbalances, but also the most restrictive planning environments. Northern regions have more adequate supply but weaker demand due to economic fundamentals. This creates a mismatched market that cannot self-correct without significant population movement or economic rebalancing. Until supply increases substantially, UK housing will remain structurally unaffordable for most workers. Rate cuts provide temporary affordability improvements, but these evaporate quickly if rates rise again. The only sustainable solution is dramatically increased housing construction, particularly in high-demand areas. This requires planning reform, infrastructure, investment, and political will that has been absent for decades. So where does this leave us? UK house prices are indeed set to rise in the near term. Falling mortgage rates have transformed affordability and unleashed pent-up demand from buyers who were priced out for 2 years. Estate agents will be busy through spring 2026. Prices will rise in most regions. Headlines will celebrate the property market recovery. But here is the crucial point that makes this rally different and potentially dangerous. The entire surge is built on assumptions about future rate cuts that are far from guaranteed. The Bank of England faces conflicting pressures from sticky inflation, government spending, global economic uncertainty, and currency considerations. If the expected rate cuts do not materialise, or if rates must rise to combat inflation, this property rally does not just slow. It could reverse, sharply trapping buyers who borrowed maximum amounts based on optimistic assumptions. For seniors watching this, I want to emphasise how important it is to be cautious in this environment. If you are considering any property-related decisions, whether that is downsizing, moving to be closer to family, or releasing equity, please take your time. Do not let anyone rush you into a decision based on the idea that prices will only go up from here. Make sure you have proper independent financial advice from someone who understands your specific circumstances. And remember that your home is more than just a financial asset. It is where you live and where you feel secure. The UK housing market in 2026 sits at what I would call a dangerous inflection point. Prices may continue rising if conditions align perfectly, or they may fall if rate expectations prove wrong. Anyone entering this market or making property decisions must understand they are essentially making a leverage bet on interest rate policy over which they have no control. Thank you so much for watching today. If you found this information helpful, please do give this video a thumbs up, as it really helps the channel grow. And if you have not already, please subscribe and hit that notification bell so you can stay informed about all the latest UK property news. I genuinely believe that staying informed is one of the best ways to protect yourself and your retirement. Drop a comment below and let me know your thoughts on the current property market. Are you planning to make any property moves this year? I read every comment and I love hearing from you. Until next time, take care of yourselves and I will see you in the next video.